While the world watches the headlines out of Iran, the sanctions, the rhetoric, the back-channel diplomacy, the actual story is happening somewhere far quieter, in the vaults of the Bank of England. Right now, nations that spent the better part of a decade methodically stacking gold, building reserves, hedging against the dollar, preparing for exactly this kind of geopolitical storm, are dumping it. By the ton. Not because they want to, not because gold stopped working, but because they've been margin called. And here's what that means in plain language. When your other assets are bleeding out fast enough, you don't get to choose what you sell. The market chooses for you. And what the market always reaches for first is the most liquid, most universally accepted store of value on the planet: gold. So what you're watching right now isn't a crisis of confidence in gold. It is a crisis of cash flow, playing out at the sovereign level. And the mechanics behind it are not complicated. They are just rarely explained. Today, I'm going to walk you through the exact sequence, gear by gear. I'm going to show you why this is happening, why it was always going to happen under these conditions, and what it almost certainly means for the price on the other side of the forced selling. This is the largest forced gold liquidation in modern history, and almost nobody is framing it correctly. Let's start with Turkey, because Turkey is the clearest example of how this trap works, and how fast it closes. Turkey imports nearly all of its energy. Oil, natural gas, almost none of it comes from the ground beneath their feet. Which means every barrel of oil on the global market is a dollar obligation. A fixed, unavoidable cost priced in a currency they don't print. Here's the math that matters. For every $10 increase in the price of oil, every single $10 move, Turkey needs approximately $5 billion additional US dollars. Not next quarter, not in their next budget cycle. Now, to keep the lights on, to keep the trucks moving, to keep the economy from seizing. Now hold that number and think about what happened when oil pushed toward $100 a barrel. That's not a $10 move. That's a $30, $40, $50 move above where their reserves were calibrated. We're talking about a $20, $25 billion hole opening up in their balance sheet in a matter of weeks. So what did Turkey do? They went to the one asset on their books that the world would buy instantly at full price, no questions asked. In 2 weeks, they liquidated roughly 10% of their national gold reserves. Decades of accumulation, gone. Not as a policy decision debated in committee, as an emergency response to a math problem that had no other solution. This is Gear 1. The energy dollar trap. And the mechanism is simple. When a nation's energy costs are priced in dollars and their dollar reserves can't keep pace with rising oil prices, gold becomes the pressure valve. It's not a choice between good options, it's a choice between gold and collapse. But Turkey is just the most visible example. Because Turkey had to move fast, and the numbers were too large to hide. Now, the Gulf states are facing a version of this trap that is arguably more dangerous because it's structural, built into the very architecture of how their economies work. And that's Gear 2. I want you to picture a bathtub. Not a metaphor yet, just a bathtub. 2 ends, a tap at one end, a drain at the other. For the Gulf states, Saudi Arabia, the UAE, Kuwait, Bahrain, that bathtub is their entire economic model. And for the better part of 4 decades, it worked beautifully. The tap was wide open, oil revenue flowing in faster than the drain could take it out, reserves building, sovereign wealth funds growing. The tub was full and getting fuller. Now picture someone turning the tap off. Not all the way, not permanently, but significantly, sharply. Because that is exactly what a disruption in the Strait of Hormuz does. Roughly 20% of the world's seaborne oil passes through that strait. When that flow is threatened, When insurance rates spike, when tankers reroute, when buyers start hedging their supply chains, the revenue side of the Gulf equation contracts almost immediately. The tap slows. But here's the part that makes this a paradox rather than just a problem. The drain doesn't slow with it. Imports keep moving. Military expenditure, which for several Gulf nations is running at historic levels right now, keeps consuming. Infrastructure commitments, social spending, currency defense operations, all of it keeps pulling from the tub at the same rate or faster. And these nations run currency pegs to the US dollar. That is the structural trap buried inside the bathtub. And to maintain that peg, to keep their currency locked to the dollar at the agreed rate, they must hold sufficient dollar reserves. The moment those reserves fall below the threshold the market trusts, the peg comes under speculative attack. And a broken peg in a Gulf economy isn't just a financial event, it is a political one, a social one, an existential one for the ruling structure. So they have to refill the tub. And to refill the tub with dollars, fast, cleanly at scale, they sell gold. Sit with the irony of that for a moment. These nations built their gold reserves specifically as a hedge against dollar dependency, against exactly this kind of moment, where geopolitical pressure and energy disruption converge. And now, to protect their connection to the dollar, as to defend the peg that ties their entire economy to US monetary policy, they are forced to liquidate the one asset that was supposed to free them from it. The hedge becomes the exit. The insurance policy becomes the emergency fund. That is the bathtub paradox. And Gear 1 and Gear 2 alone would be enough to explain a significant gold liquidation event. But there is a third gear turning simultaneously. And this one is different in nature because it isn't about desperation. It's about timing. In April 2026, Russia implements a full export ban on gold to international markets. Let that land for a second. Russia is not a minor player in this market. They are one of the largest gold-producing nations on the planet, consistently sitting in the top 3 globally, alongside China and Australia in terms of annual mine output. For years, and Russian gold has flowed into the international market, into London, into Zurich, into the hands of institutional buyers and central banks building reserves. In April, that door closes. Now the official reasoning will be framed around sanctions, around domestic reserve building, around de-dollarization strategy. And all of that is partially true, but what matters for this analysis isn't why Russia is doing it. What matters is what it does to the structure of the global gold market when they do. Because when the world's largest producers start exiting their international supply chain, the market doesn't wait for the announcement to price it in. The market front-runs it. Every private holder, every institutional trader, every sovereign fund with Russian-adjacent exposure starts calculating the same thing at the same time. If I'm going to sell, I need to sell before the door locks, and that is exactly what you are watching right now in the supply data. A surge, a temporary, concentrated, front-loaded surge of gold hitting the international market from private holders who understand that the window is closing. They are not bearish on gold, they are rational about sequencing. Get out now into a liquid market before the post-ban landscape becomes something structurally different and harder to navigate. This is Gear 3, the front-running sell-off. And here is why it matters beyond the supply numbers. When Russia exits the international market, the global gold market effectively bifurcates. You will have one market, the Western institutional market, London, New York, Zurich, operating with a structurally reduced supply base. And you will have a separate, parallel market forming around the Russia-China-India axis where gold flows but doesn't touch the Western price discovery system in the same way. 2 markets, 1 commodity, Diverging supply dynamics. The front-running sell-off you're watching right now is the last moment before that split becomes permanent. It is the final exhale of a unified global gold market. And the institutions that understand this aren't watching the price tick down and panicking. They are watching the volume. They are watching who is selling and calculating exactly when the forced selling ends and the structural supply shortage begins. Because once Gear 1, Gear 2 and Gear 3 have fully engaged, once Turkey has covered its energy gap, once the Gulf states have refilled the tub, once the Russian supply exits the international board, something very specific happens to the price. But before we get there, we need to talk about what happens in the middle. The part that shakes out the retail investor every single time. The dip. Here is the part that loses most people. Because most people watch gold dip during a crisis and conclude that gold isn't working. That the thesis is broken. That whoever told them gold was a safe haven was wrong. And they sell. Right at the moment, they should be doing the opposite. So let me explain exactly what is happening mechanically when gold dips in the middle of a supply crisis. Institutions carry leverage, not because they are reckless, because that is how institutional capital operates at scale. And when a crisis hits, when oil spikes, when a currency peg comes under pressure, and when a geopolitical event triggers margin requirements across a portfolio, those institutions don't get to sit down and rationally select which asset best fits their long-term thesis to liquidate. They sell what is liquid. Gold is the most liquid hard asset on the planet. It trades 24 hours a day. It has deep markets in London, New York, Shanghai, Dubai. There is always a bid, which means when an institution needs to raise cash fast to cover a margin call, to meet a redemption, to rebalance a portfolio that just got hit from 3 directions simultaneously, gold is the first call they make. Not because gold is weak, because gold is strong enough to absorb the selling without the market breaking. This is the liquidity grab. And it creates a window. A temporary disorienting. A deeply uncomfortable window where the price of gold moves down while every fundamental reason to own gold is moving up simultaneously. Supply is contracting. Sovereign demand is structurally intact. The dollar is under long-term pressure. The printer, and we will get to the printer in a moment, is being warmed up in the background. But the price is going down. And retail sells. Now here is what happens on the other side of the forced selling. The margin calls get covered. The institutions that needed liquidity have their liquidity. The sovereign liquidations, Turkey, the Gulf states, have accomplished what they needed to accomplish. The Russian supply has exited the international market. The front-runners have front-run, and someone has to print. Because the alternative, allowing the cascade of sovereign stress and currency peg failures and energy market dysfunction to resolve itself without monetary intervention, is not a real option for the system. It never has been. The response to a sufficiently large financial crisis in the modern era is always the same. More dollars, more liquidity, more balance sheet expansion from the institutions that exist precisely to prevent systemic collapse. The moment that liquidity enters the system, the dynamic inverts completely. The forced sellers are done. The supply surge is over. The Russian exit has reduced the structural supply base, and now fresh institutional and sovereign capital, looking for a hard asset hedge against the very inflation that the money printing will create, goes looking for gold. And the supply is gone. That is when the price doesn't move up steadily. That is when it moves vertically. And not because of sentiment, not because of fear, because of basic arithmetic. Reduced supply meeting accelerated demand in a market where the marginal seller has already left the room. The dip was not a signal to exit. It was the admission price. So let's bring the gears together. Gear 1. The energy dollar trap. Nations with no domestic oil supply and dollar-denominated energy bills hit a math wall when prices spike. Gold is the only exit that works at speed and scale. Gear 2. The Bathtub Paradox. Gulf states defending dollar pegs with a disrupted revenue tap are forced to liquidate the very asset they built to escape dollar dependency. The hedge becomes the emergency fund. Gear 3. The front-running sell-off. Russia's April 2026 exit from the international gold market is bifurcating global supply permanently. The surge you are watching right now is the last exhale before that split becomes structural. And underneath all three gears, the liquidity grab, the temporary mechanical dip that shakes out retail every single time, right before the forced selling ends and the vertical move begins. This is not a theory. There is no prediction here that requires you to believe in a conspiracy or trust a guru or accept a narrative. Every gear in this sequence is a mechanical response to a real, documented, observable constraint. Energy math, currency peg arithmetic, export policy, institutional liquidity behavior. The gold reset isn't coming because someone planned it. It's coming because the system has no other move. The smart money isn't watching the price. They are watching the vaults. They are counting the tons. And they are reading the export data and the central bank filings and the shipping manifests, because the price is always the last thing to know what the vaults already figured out weeks ago. Now you know what they know. And if this kind of analysis is what you come here for, the mechanics behind the headlines, the gears behind the noise, then do one thing before you leave. Hit subscribe. Because the next video in this series is going to show you exactly which nations are one oil spike away from their next margin call. I've built a central bank heat map, and the countries on it will surprise you. The vault doesn't lie, and neither do the numbers.